Hi, ladies and gentlemen. Today we will cover the Chapter 6. We will divide Chapter 6 with two parts. Here we go with Part 1, Cheers, Technical Analysis and the Random Walk Theory. Things are seldom what they seem. Skim milk masquerades as cream. Gilbert and Sullivan, HMS Pinafore. Not earnings, nor dividends, nor risk, nor gloom of high interest rates stay the technicians from their assigned task, studying the price movements of stocks. Such single-minded devotion to numbers has yielded the most colorful theories and folk language of Wall Street. Hold the winners, sell the losers, switch into the strong stocks, sell this issue, it's acting poorly, don't fight the tape. All are popular prescriptions of technical analysts. They build their strategies upon dreams of castles in the air and expect their tools to tell them which castle is being built and how to get in on the ground floor. The question is, do they work? Holes in their shoes and ambiguity in their forecasts. University professors are sometimes asked by their students, "If you're so smart, why aren't you rich?" The question usually rankles professors, who think of themselves as passing up worldly riches to engage in such an obviously socially useful occupation as teaching. The same question is more appropriately addressed to technicians. Since the whole point of technical analysis is to make money, one would expect that those who preach it should practice it successfully. On close examination, technicians are often seen with holes in their shoes and frayed shirt collars. I personally have never known a successful technician, but I frayed shirt collars. I personally have never known a successful technician, but I have seen the wrecks of several unsuccessful ones. Curiously, however, the broke technician is never apologetic. If you commit the social error of asking him why he is broke, he will tell you quite ingenuously that he made the all-too-human error of not believing his own charts. To my great embarrassment, I once choked conspicuously at the dinner table when a chartist made such a comment. I have since made it a rule never to eat with a chartist. It's bad for digestion. Although technicians might not get rich following their own advice, their store of words is precious indeed. Consider this advice offered by one technical service. The market's rise after a period of reaccumulation is a bullish sign. Nevertheless, fulcrum characteristics are not yet clearly present, and a resistance area exists 40 points higher in the Dow, so it is clearly premature to say the next leg of the bull market is up. If in the coming weeks a test of the lows holds and the market breaks out of its flag, a further rise would be indicated. Should the lows be violated, a continuation of the intermediate-term downtrend is called for. In view of the current situation, it is a distinct possibility that traders will sit in the wings awaiting a clearer delineation of the trend, and the market will move in a narrow trading range. If you ask me what this means, I cannot tell you. But I think the technician probably had the following in mind. If the market does not go up or go down, it will remain unchanged. Even the weather forecaster can do better than that. Obviously, I'm biased. This is not only a personal bias, but a professional one as well. Technical analysis is anathema to much of the academic world. We love to pick on it. We have two main reasons. One, after paying transactions costs and taxes, the method does not do better than a buy and hold strategy. And two, it's easy to pick on. And while it may seem a bit unfair, just remember that it's your money we're trying to save. Although the computer perhaps enhanced the standing of the technician for a time, and while charting services are widely available on the internet, technology has ultimately proved to be the technician's undoing. Just as fast as he or she creates charts to show where the market is going, the academic gets busy constructing charts showing where the technician has been. Because it's so easy to test all the technical trading rules on the computer, it has become a favorite pastime for academics to see whether they really work. Is there momentum in the stock market? The technician believes that knowledge of a stock's past behavior can help predict its probable future behavior. In other words, the sequence of price changes before any given day is important in predicting the price change for that day. This might be called the wallpaper principle. The technical analyst tries to predict future stock prices just as we might predict that the pattern of wallpaper behind the mirror is the same as the pattern above the mirror. The basic premise is that there are repeatable patterns in space and time. Chartists believe momentum exists in the market. Supposedly, stocks that have been rising will continue to do so, and those that begin falling will go on sinking. Investors should therefore buy stocks that start rising and continue to hold their strong stocks. Should the stock begin to fall, investors are advised to sell. These technical rules have been tested exhaustively by using stock price data on the major exchanges going back as far as the beginning of the 20th century. The results reveal that past movements in stock prices cannot be used reliably to foretell future movements. The stock market has little, if any, memory. While the market does exhibit some momentum from time to time, it does not occur dependably, and there is not enough persistence in stock prices to make trend-following strategies consistently profitable. Although there is some short-term momentum in the stock market, as will be described more fully in Chapter 11, any investor who pays transactions costs and taxes cannot benefit from it. Economists have also examined the technician's thesis that there are often sequences of price changes in the same direction over several days, or several weeks or months. Stocks are likened to fullbacks who, once having gained some momentum, can be expected to carry on for a long gain. It turns out that this is simply not the case. Sometimes one gets positive price changes, rising prices, for several days in a row. But sometimes when you are flipping a fair coin, you also get a long string of heads in a row, and you get sequences of positive or negative price changes, no more frequently than you can expect random sequences of heads or tails in a row. What are often called persistent patterns in the stock market occur no more frequently than the runs of luck in the fortunes of any gambler. This is what economists mean when they say that stock prices behave very much like a random walk. Just what exactly is a random walk? To many people, this appears to be arrant nonsense. Even the most casual reader of the financial pages can easily spot patterns in the market. For example, look at the stock chart on page 138. The chart seems to display obvious patterns. After an initial rise, the stock turned down and then headed persistently downhill. Later, the decline was turned down and then headed persistently downhill. Later, the decline was arrested and the stock had another sustained upward move. One cannot look at a stock chart like this without noticing the self-evidence of these statements. How can the economist be so myopic that he cannot see what is so plainly visible to the naked eye? The persistence of this belief in repetitive stock market patterns is due to statistical illusion. To illustrate, let me describe an experiment in which I asked my students to participate. The students were asked to construct a stock chart showing the movements of a hypothetical stock initially selling at $50. For each successive trading day, the closing stock price would be determined by the flip of a coin. If the toss was a head, the students assumed that the stock closed 1-2 point higher than the preceding close. If the flip was a tail, the price was assumed to be down by 1 or 2. The chart below is the hypothetical stock chart derived from one of these experiments. The chart derived from random coin tossings looks remarkably like a normal stock price chart and even appears to display cycles. Of course, the pronounced cycles that we seem to observe in coin tossings do not occur at regular intervals as true cycles do, but neither do the ups and downs in the stock market. It is this lack of regularity that is crucial. The cycles in the stock charts are no more true cycles than the runs of luck or misfortune of the ordinary gambler. And the fact that stocks seem to be in an uptrend, which looks just like the upward move in some earlier period, provides no useful information on the dependability or duration of the current uptrend. Yes, history does tend to repeat itself in the stock market, but in an infinitely surprising variety of ways that confound any attempts to profit from a knowledge of past price patterns. In other simulated stock charts derived from student coin tossings, there were head and shoulders formations, triple tops and bottoms, and other more esoteric chart patterns. One chart showed a beautiful upward breakout from an inverted head and shoulders, a very bullish formation. I showed it to a chartist friend of mine who practically jumped out of his skin. "What is this company?" he exclaimed. "We've got to buy immediately. This pattern's a classic. There's no question the stock will be up 15 points next week." He did not respond kindly when I told him the chart had been produced by flipping a coin. Chartists have no sense of humor. I got my comeuppance when Business Week hired a technician adept at hatchet work to review the first edition of this book. My students used a completely random process to produce their stock charts. With each toss, as long as the coins used were fair, there was a 50% chance of heads, implying an upward move in the price of the stock, and a 50% chance of tails and a downward move. Even if they flipped 10 heads in a row, the chance of getting a head on the next toss was still 50%. Mathematicians call a sequence of numbers produced by a random process, such as those on our simulated stock chart, a random walk. The next move on the chart is completely unpredictable on the basis of what has happened before. The stock market does not conform perfectly to the mathematician's ideal of the complete independence of present price movements from those in the past. There is some momentum in stock prices. When good news arises, investors often only partially adjust their estimates of the appropriate price of the stock. Slow adjustment can make stock prices rise steadily for a period, imparting a degree of momentum. The failure of stock prices to measure up perfectly to the definition of a random walk led the financial economists Andrew Lo and A. Craig McKinley to publish a book entitled A Non-Random Walk Down Wall Street. In addition to some evidence of short-term momentum, there has been a long-run uptrend in most averages of stock prices in line with the long-run growth of earnings and dividends. But don't count on short-term momentum to give you some surefire strategy to allow you to beat the market. For one thing, stock prices don't always underreact to news. Sometimes they overreact, and price reversals can occur with terrifying suddenness. We shall see in Chapter 11 that investment funds managed in accordance with a momentum strategy started off with subpar results. And even during periods when momentum is present, and the market fails to behave like a random walk, the systematic relationships that exist are often so small that they are not useful to investors. The transactions, charges, and taxes involved in trying to take advantage of these dependencies are far greater than any profits that might be obtained. Thus, an accurate statement of the weak form of the random walk hypothesis goes as follows. The history of stock price movements contains no useful information that will enable an investor consistently to outperform a buy-and-hold strategy in managing a portfolio. If the weak form of the random walk hypothesis is valid, then, as my colleague Richard Quant says, technical analysis is akin to astrology and every bit as scientific. I am not saying that technical strategies never make money. They very often do make profits. The point is rather that a simple buy-and-hold strategy, that is, buying a stock or group of stocks and holding on for a long period of time, typically makes as much or more money. When scientists want to test the efficacy of some new drug, they usually run an experiment in which two groups of patients are administered pills, one containing the drug in question, the other a worthless placebo, a sugar pill. The results of the administration to the two groups are compared, and the drug is deemed effective only if the group receiving the drug did better than the group getting the placebo. Obviously, if both groups got better in the same period of time, the drug should not be given the credit, even if the patients did recover. In the stock market experiments, the placebo with which the technical strategies are compared is the buy-and-hold strategy. Technical schemes often do make profits for their users, but so does a buy-and-hold strategy. Indeed, as we shall see later, a simple buy-and-hold strategy using a portfolio consisting of all the stocks in a broad stock market index has provided investors with an average annual rate of return of about 10% over the past 80 years. Only if technical schemes produce better returns than the market can they be judged effective. To date, none has consistently passed the test. Some more elaborate technical systems. Devotees of technical analysis may argue with some justification that I have been unfair. The simple tests I have just described do not do justice to the richness of technical analysis. Unfortunately for the technician, even more elaborate trading rules have been subjected to scientific testing. Let's examine a few popular ones in detail. The filter system. Under the popular filter system, a stock that has reached a low and has moved up, say 5%, or any other percent you wish to name, is said to be in an uptrend. A stock that has moved down 5% from a peak is said to be in a downtrend. You're supposed to buy any stock that has moved up 5% from its low and hold it until the price moves down 5% from a subsequent high, at which time you sell and perhaps even sell short. The short position is maintained until the price rises at least 5% from a subsequent low. This scheme is very popular with brokers. Indeed, the filter method lies behind the popular stop-loss order favored by brokers, where the client is advised to sell his stock if it falls 5% below his purchase price to limit his potential losses. The argument is that presumably a stock that falls by 5% will be going into a downtrend. Exhaustive testing of various filter rules has been undertaken. The percentage drop or rise that filters out buy and sell candidates has been allowed to vary from 1% to 50%. The tests covered different time periods and involved individual stocks as well as stock indexes. The results are remarkably consistent. When the higher transactions charges incurred under the filter rules are taken into consideration, these techniques cannot consistently beat a policy of simply buying the individual stock or the stock index and holding it over the period during which the test is performed. The individual investor would do well to avoid using any filter rule, and I might add any broker who recommends it. The Dow theory. The Dow theory is a great tug-of-war between resistance and support. When the market tops out and moves down, that previous peak defines a resistance area, because people who missed selling at the top will be anxious to do so if given another opportunity. If the market then rises again and nears the previous peak, it is said to be testing the resistance area. Now comes the moment of truth. If the market breaks through the resistance area, it is likely to keep going up for a while, and the previous resistance area becomes a support area. If, on the other hand, the market fails to penetrate the resistance area and instead falls through the preceding low where there was previous support, a bear market signal is given and the investor is advised to sell. The basic Dow principle implies a strategy of buying when the market goes higher than the last peak and selling when it sinks through the preceding valley. There are various wrinkles to the theory, but the basic idea is part of the gospel of charting. Unhappily, the signals generated by the Dow mechanism have no significance for predicting future price movements. The market's performance after sell signals is no different from its performance after buy signals. Relative to simply buying and holding the representative list of stocks in the market averages, the Dow follower actually comes out a little behind because the strategy entails a number of extra brokerage costs as the investor buys and sells when the strategy decrees. The relative strength system. In the relative strength system, an investor buys and holds those stocks that are acting well, that is, outperforming the general market indexes. Conversely, the stocks that are acting poorly relative to the market should be avoided or perhaps even sold short. While there do seem to be some time periods when a relative strength strategy would have outperformed a buy and hold strategy, there is no evidence that it can do so consistently. As indicated earlier, there is some evidence of momentum in the stock market. Nevertheless, a computer test of relative strength rules over a 25-year period suggests that such rules are not, after accounting for transactions, charges, and taxes, useful for investors. Price-volume systems. Price-volume systems suggest that when a stock, or the general market, rises on large or increasing volume, there is an unsatisfied excess of buying interest, and the stock will continue its rise. Conversely, when a stock drops on large volume, selling pressure is indicated and a sell signal is given. Again, the investor following such a system is likely to be disappointed in the results. The buy and sell signals generated by the strategy contain no information useful for predicting future price movements. As with all technical strategies, however, the investor is obliged to do a great deal of in and out trading, and thus his transactions costs and taxes are far in excess of those necessitated in a buy and hold strategy. After accounting for these costs, the investor does worse than he would by simply buying and holding a diversified group of stocks. Reading chart patterns. Perhaps some of the more complicated chart patterns, such as those described in the preceding chapter, are able to reveal the future course of stock prices. For example, is the downward penetration of a head and shoulders formation a reliable bearish omen? As one of the Gospels of charting technical analysis puts it, one does not bring instantly to a stop a heavy car moving at 70 miles per hour and all within the same split second turn it around and get it moving back down the road in the opposite direction. Before the stock turns around, its price movements are supposed to form one of a number of extensive reversal patterns as the smart money traders slowly distribute their shares to the public. Of course, we know some stocks do reverse directions in quite a hurry. This is called an unfortunate V formation. But perhaps some chart configurations can, like the Roman soothsayers, accurately foretell the future. Alas, the computer has even tested more arcane charting techniques, and the technician's tool has again betrayed him. In one elaborate study, the computer was programmed to draw charts for 548 stocks traded on the New York Stock Exchange over a 5-year period. It was instructed to scan all the charts and identify any one of 32 of the most popularly followed chart patterns. The computer was told to be on the lookout for heads and shoulders, triple tops and bottoms, channels, wedges, diamonds, and so forth. Because the machine is a very thorough, though rather dull worker, we can be sure that it did not miss any significant chart patterns. When the machine found that one of the bearish chart patterns, such as a head and shoulders, was followed by a downward move through the neckline toward décolletage, a most bearish omen, it recorded a sell signal. If, on the other hand, a triple bottom was followed by an upside breakout, a most favorable augury, a buy signal was recorded. The computer then followed the performance of the stocks for which buy and sell signals were given and compared them with the performance record of the general market. Again, there seemed to be no relationship between the technical signal and subsequent performance. If you had bought only those stocks with buy signals and sold on a sell signal, your performance after transactions costs would have been no better than that achieved with a buy and hold strategy. Randomness is hard to accept. Human nature likes order. People find it hard to accept the notion of randomness. No matter what the laws of chance might tell us, we search for patterns among random events wherever they might occur, not only in the stock market but even in interpreting sporting phenomena. In describing an outstanding performance by a basketball player, reporters and spectators commonly use expressions such as LeBron James has the hot hand or Kobe Bryant is a streak shooter. Those who play, coach, or follow, or Kobe Bryant is a streak shooter. Those who play, coach, or follow basketball are almost universally convinced that if a player has successfully made his last shot or last few shots, he is more likely to make his next shot. A study by a group of psychologists, however, suggests that the hot hand phenomenon is a myth. The psychologists did a detailed study of every shot taken by the Philadelphia 76ers over a full season and a half. They found no positive correlation between the outcomes of successive shots. Indeed, they found that a hit by a player followed by a miss was actually a bit likelier than the case of making 2 baskets in a row. Moreover, the researchers looked at sequences of more than 2 shots. Again, they found that the number of long streaks, that is, hitting of several baskets in a row, was no greater than could have been expected in a random set of data, such as flipping coins in which every event was independent of its predecessor. Although the event of making one's last 2 or 3 shots influenced the player's perception of whether he would make his next shot, the hard evidence was that there was no effect. The researchers then confirmed their study by examining the free throw records of the Boston Celtics and by conducting controlled shooting experiments with the men and women of the Cornell University varsity basketball teams. These findings do not imply that basketball is a game of chance rather than skill. Obviously, there are some players who are more adept at making baskets and free throws than others. The point is, however, that the probability of making a shot is independent of the outcome of previous shots. The psychologists conjecture that the persistent belief in the hot hand could be due to memory bias. If long sequences of hits or misses are more memorable than alternating sequences, observers are likely to overestimate the correlation between successive shots. When events sometimes do come in clusters and streaks, people refuse to believe that they are random, even though such clusters and streaks do occur frequently in random data such as are derived from the tossing of a coin. A gaggle of other technical theories to help you lose money. Once the academic world polished off most of the standard technical trading rules, it turned its august attention towards some of the more fanciful schemes. The world of financial analysis would be much quieter and duller without the chartists, as the following techniques amply demonstrate. The hemline indicator. Not content with price movements, some technical analysts have broadened their investigations to include other movements as well. One of the most charming of these schemes has been called by the author Ira Cobley the bull markets and bare knees theory. Check the hemlines of women's dresses in any given year, and you'll have an idea of the direction of stock prices. The following chart suggests a loose tendency for bull markets to be associated with bare knees and depressed markets to be associated with bear markets for girl watchers. For example, in the late 19th century and early part of the 20th, the stock market was rather dull, and so were hemlines. But then came rising hemlines and the great bull market of the 1920s, to be followed by long skirts and the crash of the 1930s. Actually, the chart cheats a bit. Hemlines fell in 1927 before the most dynamic phase of the bull market. Things did not work out as well in the post-World War II period. The market declined sharply during the summer of 1946, well in advance of the introduction of the new look featuring longer skirts in 1947. Similarly, the sharp stock market decline that began at the end of 1968 preceded the introduction of the midi-skirt, which was high fashion in 1969 and especially in 1970. How did the theory work out during the crash of 1987? You might think the hemline indicator failed. After all, in the spring of 1987, when designers began shipping their fall lines, very short skirts were decreed as the fashion for the time. But along about the beginning of October, when the first chill winds began blowing across the country, a strange thing happened. Most women decided that mini-skirts were not for them. As women went back to long skirts, designers quickly followed suit. The rest is stock market history. And how about the severe bear markets of the first decade of the 2000s? Unfortunately, you guessed it, pants became the fashion. Women business leaders and politicians always appeared in pantsuits. Now we know the real culprit for the punishing bear markets of the period. Even though there does seem to be some evidence in favor of the theory, don't be too optimistic about expecting the hemline indicator to give you a leg up on market timing. No longer are women imprisoned by the tyranny of hemlines. As Vogue put it, you can now dress like a man or woman, and all hemline lengths are now okay. I'm afraid this stock market theory has undoubtedly outlived its usefulness. The Super Bowl indicator. Why did the market go up in 2009? That's easy to answer for a technical analyst who uses the Super Bowl indicator. The Super Bowl indicator forecasts how the stock market will perform on the basis of which team wins the Super Bowl. A victory by an original member of the National Football League, such as the Steelers in 2009, predicts a bull market in stocks, whereas a victory by an original member of the American Football League is bad news for stock market investors. In 2002, the Patriots, AFL team, defeated the Rams, NFL, and the market responded correctly by falling sharply. Although the indicator sometimes fails, it has been correct far more often than it has been wrong. Naturally, it makes no sense. The results of the Super Bowl indicator simply illustrate nothing more than the fact that it's sometimes possible to correlate two completely unrelated events. Indeed, Mark Hulbert reports that the stock market researcher David Lineweber found that the indicator most closely correlated with the S&P 500 index is the volume of butter production in Bangladesh. The odd lot theory. The odd lot theory holds that except for the investor who is always right, no one can contribute more to a successful investment strategy than an investor who is invariably wrong. The odd lotter, according to popular superstition, is that kind of person. Thus, success is assured by buying when the odd lotter sells and selling when the odd lotter buys. Odd lotters are the people who trade stocks in less than 100 share lots. Called odd lotters are the people who trade stocks in less than 100 share lots, called round lots. Many amateurs in the stock market cannot afford the $5,000 investment to buy a round lot, 100 shares, of stock selling at $50 a share. They are more likely to buy, say, 10 shares for a more modest investment of $500. By examining the ratio of odd lot purchases, the number of shares these amateurs bought during a particular day, to odd lot sales, the number of shares they sold, and by looking at what particular stocks odd lotters buy and sell, one can supposedly make money. These uninformed amateurs, presumably acting solely out of emotion and not with professional insight, are lambs in the street being led to slaughter. They are, according to legend, invariably wrong. It turns out that the odd lotter isn't such a stupendous dodo after all. A little stupid? Maybe. There is some indication that the performance of odd lotters might be slightly worse than the stock averages. However, the available evidence indicates that knowledge of odd lotters' actions is not useful for the formulation of investment strategies.